Thank you everyone for joining us tonight. Obviously, we're going to be talking about using equity to purchase an investment property, how that works, and all the details that you need to know before jumping in. So before I get started, I'd like to introduce our hosts for tonight. I will introduce our team, and I do just want to encourage questions along the way. This is going to run for about 45 minutes to 50 minutes. So if you've got any questions that pop up, put them through the chat. If I can't respond straight away, we will run through questions at the very end. So I've got my co-host with me today, David Thurmond.
Hello, everyone.
And we've got our panelists, Carly McCann and Manjula Ezra.
Hi, everyone.
And you'll also see Ash here as well, who's going to be helping me field the questions that come through. So let's get started. So our team. Some of you would have met them before. As I said, we've got our brokers and our panelists that are here tonight. And we've also got a fantastic admin team that support us with processing the loans and helping get the best results for our clients. So our main office is in Berwick, on High Street in Berwick. So for those of you familiar with Berwick, it's just between the library and the pub there on the corner. So nice and local. Now, what we'll discuss tonight, we are going to start by talking about the state of the market. And this is quite a big topic, so we need to make sure that it's thoroughly discussed before we get into the crux of investing. We'll be talking about interest rates, obviously on everyone's mind, inflation, and the property market. Of course, if we're purchasing an investment property, what's happening in the market, we need to know. Then we'll get into the nitty-gritty of how you purchase an investment property with equity. And then we're going to go into some more detail in terms of the structure and why the structure of an investment property purchase is so important. Once we've discussed all of those, we'll run through briefly what kind of professionals you need to have on your side when you're purchasing a property, and ideally discussing your situation with those professionals before you purchase. And at the end, we'll run through some questions, as I said. I'll hand over to my co-host, David, to discuss the state of the market.
Fantastic. Thank you very much. Thank you, everyone, for joining us tonight. I love the topic that we're discussing tonight. What an opportunity and what an honor it is to help clients with probably the biggest purchase that they'll ever make in their lives, and something that will help set them up for the future. So I absolutely love this topic. Before we get into it, as with any presentations, this is all generic in nature and just general. If you want specific advice for yourself, then we'll need to arrange a one-on-one appointment tonight. All right, so cutting into it, we'll talk about inflation and interest rates because that's a pretty hot topic right now with everyone, and it has a direct impact likely on the decisions that you'll be making and when you might purchase. So inflation, just in simple terms, is the rise in the cost of goods and services. An example of inflation is if you had a television that you purchased in 2021 and we had 10% inflation over the last year, then that television would now be a $2,200 television instead of a $2,000 television. So just an example of how inflation works and how it increases the cost of goods. Now, how will inflation affect you? Obviously, we've spent the last 7 months seeing nothing but interest rate rises. We haven't had rises since 2014, so to all of a sudden see rises coming on strong, it's been quite a shock to the system, and it's all due to the Reserve Bank trying to curb inflation. The other issue that we've got is obviously higher cost of living. Everything that we buy in today's world is more expensive. If you're flying somewhere, if you're paying for petrol, in your car, if you're buying groceries, then everything is now more expensive. I thought I'd share with you a bit of a chart. I love graphics like this, and we'll be showing you a ton more. So I'm going to really nerd out on some of this stuff. What the first chart on the left-hand side is showing you is the drastic increase in inflation over the last year or so. And there are two lines to pay attention to. One is the black line. It's called headline inflation, and the red line is called underlying inflation. Now, headline inflation is for those event-specific occurrences around the world that impact the cost of goods. So, for example, the war in Ukraine has drastically increased petrol prices. Floods in Queensland and New South Wales have increased the cost of our veggies. So those are things that are completely out of our control and kind of one-offs. That's basically the headline inflation. Underlying inflation is just the overall cost of goods, like everything in our world is going up in price. And you can see on the right-hand side where the biggest impacts have been made, and transport is leading the way at 13% increase. Basically, the cost of petrol has really driven that. But also housing at 9%, like the cost of building a house is a lot more expensive now than it was 24 months ago. All right, so inflation is still an issue, and it's likely that we're not going to see that back under control for another year or so. And because of inflation, because it's a bit out of control right now, the Reserve Bank is trying to use the only tool in their bag to control that inflation, and that is interest rates. So since May, they have increased interest rates 7 times. They started out with 0.5% increases. Now they've gone to 0.25% increases over the last 2 months. And the projection is that we'll see another couple of increases in December and potentially in February before they reach a peak. And then it starts to plateau for what the market is expecting around 12 months, where we'll see interest rates sit sideways and then potentially falling in 2024. Now, if you look at the last 12 months, you see we've had nothing going on for a good 24 months. And then all of a sudden we saw this drastic increase. And I'd just like to put things into a bit of perspective. You know, it's really easy to sit back and look at this chart and think, oh my God, you know, the world is falling apart because our interest rates are going through the roof. And does this mean that we're going to be back to 17 or 18% interest rates like we saw in the 1990s? I don't think that's the case. And here's why. If we zoom out a little bit and we look at interest rates over the last 30 years, we can see that in the grand scheme of things, we're still doing okay. Yes, we've had some increases over the last 7 months, but that's just to get interest rates back to normal and to try and curb inflation. If you look across, that red line going across represents what interest rates are today, or what the cash rate is today. And in comparison to the last 30 years, we're not that bad. As far as where we're going, the market expectation, like I said a second ago, is that we'll increase a little bit more, maybe 0.5%, maybe 1% at worst. And then we'll plateau for a period of time before they'll start to bring interest rates back down. The idea is that the Reserve Bank, in using interest rates to control inflation, they will eventually break the economy. And they'll have to get the economy started again by decreasing interest rates and stimulating our spending. So the projection is that by early to mid 2024, we'll start to see interest rates come back down and hopefully return to maybe 3.5%, somewhere in there. So time will tell on that. How will higher interest rates affect you? I think a lot of you already know this. Borrowing capacity is obviously a big deal. If you're looking to borrow money, that's more expensive now. So the amount of money that you can borrow has come down quite a bit. And obviously reduce cash flow. If interest rates have increased, it means that you're paying more per month for your mortgage and you've got less cash in the bank to spend on your own. Now, the other factor in our state of the market is the property market. And when we talk about property, it's really easy to, doom scroll on a Twitter or Facebook or the Herald Sun website, God forbid, and see nothing but doom and gloom projections on the property market. And I just think everything needs to be taken with a grain of salt. And I'll show you why. A couple of articles that came out a couple of months ago. One was the New South Wales and Victorian property market takes a $200 billion hit. And you look at that headline, you think, oh my God, the world's blowing up. You know, what's going to happen with my property? Or house prices plunge, spreads with biggest monthly decline in 39 years. That sounds pretty bad, doesn't it? But again, we need to put things into perspective. And if we look at that first article, that $200 billion hit to the property, as far as the number of dwellings that we have in Victoria and New South Wales, there are 2.5 million properties in Victoria, 3.3 million properties in New South Wales. So we've got over 5.8 million properties across those two states. It comes out to an average of $34,000 in loss per dwelling. And when you put it in that perspective, you think, well, that's not that bad. $200 billion sounds like a big number, but per dwelling, it doesn't sound that bad. And it gets even better. When we look at this graph here, what this chart is showing you, the purple blocks or areas around Melbourne, those are actually properties that have increased in value in this last year. So in the southeast suburbs where we're located, our annual growth is at 4%. If you look in the inner suburbs, where the more expensive multi-million-dollar properties are in the inner suburbs and around the CBD, that's where they've seen 8 to 10% drops in value. So even going back to that figure where we've had a loss of $34,000 per dwelling, my house in Berwick has likely not gone down by that much. It's a property in Toorak and Brighton that might have gone down by $100,000. So when you average it all out, it's not that bad. I'll get off my horse now. Prices have fallen across most parts of the country over the past months, and we'll continue to see a gradual decline in property values over the next 12 months. But what I really wanted to focus on was the drastic increase that we've seen in values since 2015. So if you've had a property over the last 5 years, you've experienced a massive amount of growth. So even if we see a slight correction in the property market over the next 12 to 24 months, it's likely you'll still have a great deal of equity available to help purchase an investment property if that's what you're looking to do. The other thing that gives me a deal of confidence relating to our property market and also our lending environment. Australia is a super conservative place for lending. If you think back to 2007 and 2008, when the world was going through the global financial crisis, Australia wasn't affected. We had a fantastic opportunity with our exports. At the time, we were sending out a lot of iron to China, so we're making a lot of money that way. But we also had really strong lending practices. And so a lot of the issues that Europe and the US had, where their housing market blew up, we didn't have those because our banks are so strict. And for those of you that have borrowed in the last 5 years, you know what I'm talking about. When we submit applications, we have to ask a lot of questions. We have to provide a lot of proof of information, and that keeps our lending environment safe. And if our lending environment's safe, then usually our property market follows. So this chart here is showing a low level of arrears in the last quarter, which is a fantastic sign that even though we've had increased interest rates, we're actually still doing okay. We do expect there to be some struggles next year because half the lending market is going to come off fixed rates, and clients will go from 2% fixed rates to 5% variable rates. That's going to be a bit of a shock to the system. So time will tell on how the property market will play out, but so far so good. Now, the main topic for tonight, obviously discussing purchasing a property and using equity in our existing home to do that. This discussion tonight, as David said, it's going to last about 45 to 50 minutes, and it's quite meaty. There's a lot to it. There's a lot of detail involved. Normally, when we sit down with clients and talk to them one-on-one about purchasing an investment property, it's a good 45 minutes to an hour just to go through their specific situation. So we will be covering off on a lot of information, but we'll try and keep it interesting. Now, investing in property, we'll talk about the benefits and risks of investing. We'll talk about equity and what it actually is. How do we use equity instead of savings? That's a massive one. A lot of clients, when they're purchasing an investment property, they don't want to use the savings in their bank. They want to use the equity in their existing home to leave that savings where it is so they can maintain some flexibility. We'll talk about why loan structure and entity structure are super important. And what I mean by entity, that's who is purchasing the property. Is it you as an individual? Is it a trust? Is it a self-managed super fund? So knowing the structure is super important for us as mortgage brokers, because that helps us determine the best lending options for you and the restrictions potentially that we need to deal with. We'll also talk about getting good advice, so getting the right professionals in your corner and how important that is. So benefits of investing in property. There are two main benefits, two main benefits, tax savings. And with tax savings, we're looking at depreciation and negative gearing. So we'll tackle depreciation first. Depreciation is just an accounting method that reflects the diminishing value of an asset. So if you bought a TV today for $500 and that decreases in value by $50 a year, that's a depreciation. That's the value diminishing over time. So with depreciation, if we make an assumption that we've got a $600,000 property and that property was purchased in 2022 and it was built in 2010 and it's got average fittings, then your accountant, by using a depreciation schedule, can hopefully decrease your taxable income by about $3,000 thanks to that depreciation. Now, depreciation is determined by the age of the property, the condition of the property, the quality of the fittings. All of that determines the percentages that an accountant can use to determine your tax benefit. Negative gearing. Negative gearing is the annual cost of an asset. When the annual cost of an asset is more than the income earned. And a quick explanation of that, if we've got a $600,000 property, we would have annual costs of about $33,800. So that's about $30,000 in interest, $1,800 in management fees, and about $2,000 in maintenance. Now, these are all just rough assumptions, and we try to be very conservative with these numbers. So hopefully by the time you actually get to speaking with your accountant, they look a lot better. As far as the income, we're estimating about $26,000 in rent received. And you notice there that there's a loss of $7,800 being made on this property. So a lot of clients think that they'll buy a property and they'll actually be positively geared. They'll actually make money on it. And with most properties now, especially because interest rates have increased, with most properties, you are losing money. And it sounds like a bad thing. No one wants to lose money. But there are some ways that you can get the ATO to help you out with that. So when we look at tax savings, we've got Mary Smith here, who's purchased this property at $600,000, and Mary's got a taxable income of $130,000. And on that $130,000, she'll pay about $36,000 in tax. Now, Mary has just bought this property at $600,000, and she's got depreciation that she can claim back of $3,000, and she's got an investment loss that she made of $7,800. Remember, that was the loss that she made from paying her mortgage and her maintenance and her management fees versus the income that she was earning. So she's in total, she's getting about a $10,800 tax deduction. So we've got an adjustable taxable income of $119,200. So her taxable income has dropped from $130,000 down to $119,000, and her adjusted tax payable has dropped from $35,000 down to $31,000. So she's got a tax savings of $4,176. So when we look at who's actually paying for this property, we can see that the ATO is covering $4,176 because that's the tax benefit that we just received from the depreciation and the negative gearing. The tenant is paying $26,000 and the client is left to pay $36,024. Now, $36,024, if we divide that by 52, that gives us an out-of-pocket expense of about $70 per week. So if you were to buy a $600,000 property, or sorry, if Mary was to buy a $600,000 property, then she would need to fork out about $69 a week to cover that. All right, so that's just a very rough guide on who is actually paying for this mortgage and how the ATO can help chip in by using depreciation and negative gearing. These numbers will vary wildly depending on the property that you purchase, your own tax position, the entity that's purchased the property, et cetera. So obviously you want to speak to your accountant about how this might affect you. And we'll get to speaking with professionals in a little bit. All right, so the other benefit is capital growth. And capital growth is the increase in the property's value. So you buy it at $600,000 today, and you hope like heck that it goes up next year and the next year and the next year. On average, properties in Australia have grown about 6%, and this is since 2004. Now, this will obviously not look as good with the latest reductions over the last 12 months. But if we keep in mind that the previous 5 years, we grew at about 30%. On average, we're sitting at roughly 6% growth a year. Growth will vary also based on where you purchase. So are you purchasing in metropolitan Melbourne? Are you purchasing in regional New South Wales? What you purchase, are you purchasing a townhouse or a detached home? And how much you purchase for. Obviously, the more you spend, usually it means that you're going to get better capital growth because you're buying a better quality property that people are desperate to buy from you in 5 years' time or desperate to rent from you. We'll talk about the type of property first, and then we'll get into the location as well. Now, with units, the benefits of a unit are that they most often bring you a higher rental yield, meaning that you get more rental income for that property. They're more affordable because they don't cost as much as detached homes or houses. Because they cost less, then there's less outflow of your own cash. The downside is that you've got management fees. You normally have a strata cost or some kind of a body corporate fee that you need to pay for that property. The other issue with units is usually we see less capital growth in units because there's less land involved. For houses, they usually gain more in value, so you get better capital growth, but they're also bigger properties that need to be maintained. So if you're looking to buy a house and rent it out, then you're relying on the tenant to continue to look after the property, not just the inside of the house, but the land itself. Now, what and where to purchase? There are a number of things that we've listed here. I'll just quickly go through them. Obviously, the things that will benefit you would be good access to public transport. In the end, we're looking to attract as many tenants as possible, right? We want to create the demand for your property. Anything close to the CBD or major developments, proximity to schools, parks, and shopping centers, major developments planned for an area. So if you know of an area where a big hospital is being put in, or a business precinct, things like that, those are always beneficial. Is there a master plan for the area by the council? Have you got insight into what the council's planning to do with a certain area? What is the quality of local developments? What does the supply of rental properties look like? So there are a number of things that you could look at to determine if a property is worthwhile. Now, where to purchase? Most clients that we speak to will purchase in their own backyard because that's what they're familiar with. So if we're speaking to a client that lives in Berwick, usually they're looking in the southeast suburbs or surrounds because that's what they're familiar with. They know the areas, they can drive to the areas, they feel more comfortable that way. But oftentimes your own backyard is not necessarily the best place to purchase. Potentially we're not looking at the best capital growth in the outer suburbs. We also could potentially be getting less rental return, or you could just be in a down cycle for this area, and maybe Brisbane or Sydney or Perth are in a better property cycle. So it all depends on when you're looking to purchase, and considering that maybe someplace outside of your own backyard might be beneficial. Now, when we look at capital growth, and we talked about the growth of 6% on average since 2004, put a chart together to show you what a $600,000 purchase at 5% growth would look like over the next 30 years. And again, these are projections, and we don't want to get too wrapped up in what that 30-year figure looks like. But even looking at the 10 and the 20-year figures, I mean, if you bought a property in 2022 at $600,000, going off of past performance, the property in 10 years would be worth around $977,000, and in 20 years, close to $1.6 million. So you can see what a massive benefit this would do for you in retirement. If you're looking to not just rely on the pension, if you're looking to get a property that will potentially pay itself off and then be available for sale in 20 or 30 years time, and then you cash in and live a decent life in retirement. Now, when we talk about better future, what we're looking for with investment properties is to hopefully set yourself up for retirement and to also potentially help your kids. The other thing that properties can do, or investment properties can do, is to help pay off your own family home faster. And what we mean by that, when we're looking at setting yourself up or you're setting your kids up, we go back to the same chart we looked at a second ago, and we can see what a benefit $1.6 million would do for us in 20 years time, and how that could potentially help us in retirement or help our kids. But we've also got software that helps show clients that if they were, for example, to purchase an investment property now, in 13 years time or in 15 years time, that property could potentially be sold to then pay off your own owner-occupied home, so that you're paying off your owner-occupied home faster and guaranteeing your future, or at least protecting that property and knowing that you don't have a mortgage to worry about anymore. So we take clients at this software quite a bit when they're considering holding properties for that 10 to 15 year mark to see if it could potentially pay off their mortgage faster. The risks of investing in property. The current market is obviously uncertain. We've got inflation that we're dealing with, higher interest rates. But in my mind, where one door closes, then a window opens. So where there's uncertainty, there's also opportunity. Decreases in value. We don't know yet how far the property market will decrease. The projection is that it will drop between 10 and 20% over the next 12 months. but time will tell. There's a lot of signs also saying that the property market's not doing as bad as a lot of people are predicting. Tenants are also part of the risk of investing. You're relying on someone to look after your property, to continue paying their rent, and to look after the property and the maintenance of it. So, and then obviously the ongoing repairs and maintenance could potentially be an out-of-pocket expense. If you had a water heater go out, or if you had a roof cave in or something like that, then obviously there's some big repair bills that you have to look after. So that's definitely a risk. Now, the whole topic for tonight's discussion started around the idea of using equity to purchase an investment property. So we'll talk a little bit about what equity is first, and then we'll get into some examples and case studies of how it might work for you. Equity is just the difference between the value of your home and the balance of the loan. So if we look at this beautiful house here that's worth $1 million, and we've got a loan balance of $445,000, well, the equity is just the difference between the two. We've got equity in this property of $555,000. All right, so in simple terms, that is what equity is. So let me switch over to a different bit of software, and we'll take you through a bit of a case study on how we can use equity to help you purchase. All right, so, excuse me, there are two options when it comes to structuring the drawdown of equity or the use of equity to help purchase a property. The first one is the best option. It's the preferred option. So we'll talk about that one first. In our example, we've got a family home that's worth $1 million. And that family home has a loan of $445,000 secured against it. It's an owner-occupied loan on principal and interest repayments. And we want to purchase a property for $600,000. Now, on a purchase of $600,000, we usually have about 6% in government and legal fees. That includes conveyancing costs, stamp duty, transfers, registrations, and land tax or council rates. So all up, we're looking at a total cost of $636,000. Now, if I tried to secure $636,000 against this home that's only worth $600,000, you can see that we're trying to borrow 106% of the value of that property, or 106% loan to value ratio. And the banks say, thanks, but no thanks. We're not going to do that. So we need to get this loan down to a level where the bank's actually going to be happy with it. So we want to get this loan down to 80%, so we don't have to pay mortgage insurance. And 80% of 600,000 is 480,000. But we still need 156,000 to complete our purchase because we need a total of 636,000. We know we can't secure that 156,000 here. So we take that 156,000 and we borrow it against your existing family home. Now, to keep your accountant happy, to keep the ATO happy, to keep everyone happy, we do these loans separately. We don't want to combine these two loans because this is your owner-occupied loan. That's for personal use. And this is your $156,000 investment loan. So we don't combine them. We never, ever want to combine them because we want to keep them separate so that at the end of the tax year, you can take loan statements for this loan and for this loan to your accountant and get your tax deductions on the interest and the fees that were charged throughout the year. All right, so there's a method to the madness. We want to keep these loans separate. And you notice this big gray line here, that's there on purpose. It shows that we are not cross-securing anything. So this property is only securing this loan. This property is only securing these two loans. The other common question that we get is, David, why are we securing $156,000 against my owner-occupied loan or owner-occupied home? Doesn't that make it an owner-occupied loan? No, it does not. Very good question, very common question. What the ATO is looking at is what was the purpose of this loan? And the purpose of this $156,000 was to help purchase this property. So the ATO says that's fine. You can treat it as an investment loan. So at the end, you can get tax deductions on the interest and the fees that are charged on that loan, as long as we keep them separate. So we're at 80% loan to value ratio here. The bank's happy, we're happy. And we're at 60% combined loan to value ratio here. The bank's happy, we're happy. So this structure is good to go. Now, I'll show you the bad way of doing investment lending. and that is by cross-securing. And by cross-securing, we take one property that's worth $1 million, and then we add in a second property. This is our investment purchase that's worth $600,000. So now we've got $1.6 million in total value. And then we've got a loan of $445,000, which is our existing owner-occupied loan. And we've got a new loan of $636,000, which is our investment loan. So you look at this and you think, well, that's great, David. There's only one loan here instead of two. That's easy. Fantastic. And we're under 80%, so we don't need lender's mortgage insurance because the combined loan-to-value ratio is at 67. So that's good. The downside is when you go to sell these properties. When you try to untangle this in the future, if you try to sell one of these properties, the bank could step back and say, well, wait a minute, you've changed the loan-to-value ratio. We need you to prove that you can afford the remaining debt. So you might sell this property, for example, and get rid of that debt. But because you've still got this debt and because the loan-to-value ratio has changed, the bank wants you to reservice your loan at $445,000, meaning you have to prove that you can still afford that $445,000. And if you were to have retired or lost your job, or maybe you started a family or had another child or whatever it might be, your financial position was impacted, you might not be able to prove that you could afford that residual loan. And the bank would say, I'm sorry, you can't sell your investment property. It also makes you stickier with one bank. If you've got everything wrapped up here with one bank, then you're less likely to leave. And this is why if you go to your Commonwealth Bank branch or your NAB branch, for example, the branch lender will usually go the easy route and cross-secure everything because it's fantastic for the bank. You're less likely to leave because everything is all cross-secured and tied up. So this is bad, big no. This is good. Yes, we get an extra loan, but there's a method to the madness. There's a reason for it. And when you speak to your accountant, your financial advisor, they'll tell you the same. All right. So that is an example of the structure and how we would use equity to help purchase our property. The other thing that we need to talk about while we're on the screen here is using this loan to cover the initial deposit. When you go to purchase a property, you'll make an offer on the property. It's likely going to be an unconditional offer, and you'll need to have 10% of the purchase price ready to go and available to pay the agent straight away. So normally what we do with clients before they've actually purchased a property yet is we will refinance this existing $445,000 loan to whatever their preferred lender is. We'll get them the best interest rate that we can. And then we'll also take out an investment interest-only loan for an estimate of the 20% plus cost that we need. So for example, in this situation, we'll take out a loan of $156,000. And we make the loan interest-only so that you're not paying any interest on this $156,000 until you actually need it. So basically, it just sits there like a big credit card unused, and you don't have to pay anything for it. You don't have to pay anything until you actually draw down on it. So once you go and you purchase your home for $600,000, then we draw down $60,000 from this $156,000 and you start paying interest on $60,000. And then when the loan settles, then you would have two loans totaling $636,000 across the two properties. Hopefully that makes sense. But again, if you're interested in buying a property, we'll go through this and we'll go through your specific situation when we can get a one-on-one meeting organized. All right, gone to that one. Let's go back to this one. All right, so who should purchase the property? And what we mean by who should purchase it, what entity are we looking at? Is it going to be an individual or joint names? Is it going to be in a trust? Is it going to be in a company name or potentially in a self-managed super fund? All right, so the entity helps us determine, obviously, the tax benefits or the tax restrictions that you might have. It helps us determine what lenders we can use because not all lenders will do SMSF lending. Not all lenders like lending to a trust or a company. So depending on the entity structure that we're looking for, that will help us determine the lending options for you. So we'll go into each one and talk about the pros and cons. Let's start with individual or joint names. The pros, relatively no setup costs. If you're purchasing, let's say Mary Smith wanted to buy a property and she's just going to put it in her name, then she would just write Mary Smith as the purchaser on the contract. This is the most common setup. This is probably 90% of the clients that we speak to or the clients that purchase will purchase in their individual or joint names. The cons to this, there's very little protection legally for purchasing in your own name, because if anything were to happen, if you were in a bad business venture or if you got into a bad relationship, then there's very little protection of that asset, preventing someone from trying to cash in on it. There are also potentially high transfer costs. And what I mean by that, we'll get into a bit of an example on transfer fees. When we look at transfer of ownership, let's say that Mary and John purchased. Mary's found herself a lovely guy named John, and they purchased this property for $600,000 in 2022. And in 10 years, they've decided to gift a portion of the property to their kids, or they want to add kids to the title to help them get started in their life. Well, if we're changing the ownership of this property, then that would incur stamp duty. Mary and John would remain 50% owners. The kids would come on as 50% owners. And because there's a change of ownership, there needs to be a charge of stamp duty. And so the clients in this example would pay 50% of the total stamp duty on $1 million, which is the value of the property when the transfer was done. So obviously we want to try and avoid that if we possibly can. And this is where the importance of entity structure comes into play. Now, if we look at a trust, for example, the pros of a trust is that it offers greater protection for you. When you buy in a family trust, let's say that you get into a bad business venture, business partner goes south on you, and there are some legal issues, then having the property in a trust is its own special protected entity. It's not you owning the property, it's the trust that owns the property. So usually it's protected or is more protected from any kind of a legal dispute. It's also easier to change ownership in the future. And we'll talk about that in just a second. The downside to a trust is that there are high setup costs. It's going to cost you a few $1,000s with an accountant or an advisor to set up the trust. And then there are ongoing accounting and audit fees that you'd be mindful of as well. Now, as far as transfer of ownership in a trust, if we look at a similar arrangement here where the Smith family trust has purchased a property, and in 10 years' time, they want to transfer ownership to their children, there would be no stamp duty charged on this because the ownership is not changing. The Smith family trust is still the owner. All the clients have done is just change the trustees, the beneficiaries. So buying in a trust keeps the entity the same, and it allows you to change trustees and beneficiaries and not impact the transfer. Now, a company, there's, again, similar to a trust, there's greater protection and easier to change ownership in the future. But you've also got high setup costs and annual accounting and audit fees. Every time I've spoken to my personal accountant about buying a property in my company name, she yells at me. So I've learned by now to not ask her that anymore. So that might be just specific to my situation, but I know she's always been dead set against me purchasing anything in a company name. So obviously everyone's tax position is going to be a little bit different. So I'll leave it at that. Self-managed super funds. We get a lot of questions around clients looking to purchase a property in a self-managed super fund. The benefits of buying in your SMSF, the biggest one is that there's no capital gain tax or no capital gains tax on your purchase. So when you buy a property for $600,000 and in 10 years time, you sell it for $10 million, or sorry, not 10 million, 1 million. When you sell it for $1 million, you're not paying capital gains on that $400,000 increase, as long as you're doing it during retirement. As far as cons, there are massive setup costs involved with a self-managed super fund. There are annual fees that you have to pay to get the super fund audited. You've got to pay your accountant and a separate auditor. And the other downside with an SMSF purchase is that you can't use the equity in that property to purchase future properties. All right, so everything is locked into the fund itself. It can't be used to help leverage and buy other property. The other great benefit here is that you're not actually using your own personal savings. You're using the super that you've been building up over the last 5, 10, 15, 20 years. Usually when a client's purchasing a property in a self-managed super fund, we need to see at least $200,000 in combined super to make that work. The reason being, you need to put down a significant deposit for a self-managed super fund purchase because the bank requires that that loan is positively geared. They want to ensure that that loan balance is small enough that the rent will easily cover the cost of the mortgage and the ongoing cost of the submanaged super fund. So it needs to be positively geared, and that's why we need to see that roughly $200,000 combined balance before we can even start discussions about potentially purchasing a new super. Right, professional advice. I'm obviously biased, but I think having a professional on your side is incredibly, incredibly important. This is not buying an investment property is, like I said earlier, one of the biggest financial decisions you will make and the biggest purchases you'll ever make. You want to make sure that you're doing it right. So my recommendation is that you have an accountant, a financial advisor, a fantastic mortgage broker in Barrick, and a property specialist. All right. Property specialists are obviously optional. If you can source your own property, then fantastic. But the first three are super, super important to try and map out what your tax benefits are, to ask you what your next 10 to 15 years looks like so that they can give you the best advice on how to structure the loan and how to structure the entity purchase. So I'm a big advocate, obviously, for professional advice. Now, accountants, my personal accountant is Kayleen, who you see here in this picture. Also with Mark and Carrie at Barrick Taxation Services. They are fantastic. I've been using them for about 15 years now for both personal and business and investing, and they are amazing. So highly recommend you seek them out if you don't have an accountant of your own. As far as financial advisors, Financial Foundations, Ty and Kieran and Wilson have been fantastic. We've been working with them for a number of years now, and would highly recommend you seek them out if you want to look at, if you're big picture and you're looking at what does retirement look like in 60 or at 60 or at 70, and how much am I going to have in retirement? These are the people that will map that out for you and say, all right, well, if you want to have $2 million in assets by the time you're 70 years old, here are the steps you need to take now. All right. Super, super important. It's one of the most underutilized services going around. Property specialists. Tony in the middle there, the follically challenged gentleman, is one of the best blokes that you'll ever meet. Super nice guy. He's got an amazing team, and they source property all over Australia for clients who are too busy dealing with their normal lives. They help clients find properties, right? So huge rep for them. I've used Tony myself, and we've had a number of clients use them as well. And they are amazing. They don't charge a fee for their service. They get paid basically like a real estate agent gets paid. So it's a no-fee service, and it's a win-win. I think they're amazing. Mortgage brokers, obviously, again, incredibly biased, but I think these people on the screen here are bloody fantastic. Strongly recommend that if you're looking to make an investment purchase, you start by speaking with your mortgage broker, and you get a good idea of your borrowing capacity. And then you can go off and speak to an accountant or financial advisor to help structure and determine what your next steps might be. One last thing before I wrap up. The 2022 federal budget came out about a month ago, and hopefully not many of you read it because it was very, very boring. But one of the biggest takes in that budget for me was that the government is planning to bring in 200,000 skilled migrants per year. So when we're talking about investing in property, we need to look at the market and we need to say, is there demand for the product that we're looking to buy? And this tells me that there is a massive demand, or will be an even greater demand, for property in the years to come. Australia is a growing economy. It is a growing country. We're looking to add to this country, whereas a lot of countries around the world are actually decreasing in population size. We're going the other way. So what a fantastic opportunity to look at investing as a way to help your future. All right. So I think I will hand it over to David Laline for now, and I'll look forward to your questions.
Yeah, thanks, David. I'm really glad that you pointed out that professionals are really the key here, and especially when it comes to finding the investment property itself, and getting advice from an accountant. Purchasing in your backyard is very common, and as you said, it's kind of the safe option that a lot of people go with, but really that's putting a lot of emotion into a very financial decision. And so having those professionals, give you the feedback and discuss what's actually best for you financially. Could rule out the backyard completely, or it could recommend it highly. But it's really important to ask that question and speak with those professionals. So really glad that you put that out. So next steps. First one is meet with the professionals. As I said, it's so important to speak with them and make sure that they're assisting you reach your goal and minimizing the risk of the property value decreasing, minimizing the risk of putting the property in the wrong entity or a less tax beneficial entity, I should say. So what's important to you, have the professionals create that and set that goal. And that's the next step afterwards, creating a plan. Is the plan for this investment property to pay off your loan in 15 years? Is it to have a retirement home and sell your current home at that point? Is it to have something that the kids can inherit in 20, 30 years time? What's the plan? And then the professionals are going to work towards developing that plan and meeting it. And finally, this is the big one, getting yourself ready. Once you've spoken with the professionals and we know what we want to achieve, we need to take that step. We need to discuss obtaining the deposit from your equity, and we need to get a pre-approval in place for the purchase so that then you can take that step and purchase a property. So meeting your professionals first, that's the big one in terms of next steps. Now, questions? We have had a few come through. I've answered a few of them. I've got a couple outstanding, so I might just read these out loud, and I'll let the panelists here field them if that's okay. Now, from Nathan, do you have to pay stamp duty on a property if it is inherited? Thanks, Nathan. Hope all is well. Carly, did you want to field that one? No, that's okay. I'll take this one over. So when
no, sorry.
Sorry? No, when you inherit a property, you do not pay stamp duty. No. Inherit is kind of the key word here. That means the person has passed away and you're inheriting that property. If you are purchasing the property from them, but they're gifting it to you as an inheritance early, then there is stamp duty applicable, yes. So it depends on the timing of that inheritance. I've got another one here. Will the bank borrow an individual to purchase an investment property for a family trust? And what amount of deposit or proof of income is required to buy an investment property under a trust? So David, I might get you to respond to that one.
Yeah, as far as the trust, I believe that the lending, for most banks, the lending's the same, whether it's an individual or a trust. Usually the maximum that you can borrow on an investment property is 90%. And I believe that's the same for a trust and an individual. Ideally, we're using enough equity in your property to get the loan down to 80%. So hopefully it's not even an issue anyway.
Yeah, fantastic, thanks. Okay, I've got kind of a two-part question here. How long should you hold on to an investment property, and should you pay interest only on these loans? Manjula, do you want to take this one?
That is a very common question, David. I get asked that a lot. Interest-only loans are one of the ways investors keep their costs down. In this instance, they are not paying principal, so the monthly repayments are lower than the principal and interest loans. Interest loans are popular with investors who want to maximize their cash flow while keeping their expenses low. Investment debt is tax deductible, as you all know. If you maintain a high loan balance, you have more to claim back as a tax deduction. However, it is important to keep in mind that interest-only loans generally have a higher interest rate, and that could also impact your borrowing capacity.
Yeah, that's very true. And in terms of how long you should hold the property, that does really come down to what your goal of the investment property purchase was. Is it to pay off the home loan, in which case sell it when it can do so? Is it to hold until retirement? That's a very subjective answer.
Just to jump in on that response from Angela, if the person's asking about interest-only repayments on the investment loan, usually clients will go interest-only on their investment because we want them to focus their principal payments on their owner-occupied loan. The idea is that your owner-occupied loan is bad debt. We want to get that paid off first because we're not getting any tax deductions on that owner-occupied debt. So rather than putting principal payments towards the investment, we want to put those principal payments towards the owner-occupied loan, get that paid down first. Meanwhile, we're leaving that investment debt as high as possible and claiming more tax benefits.
Yeah, absolutely right. I've got a question here from Naomi. Carly, this one's for you. Do you need to have healthy savings prior to investing?
So the short answer is no. As we sort of saw in the example from David, if you've got an owner-occupied property with equity, you don't actually need to put any cash in at all if you have the ability to service those loans. If you're purchasing investment only and you don't have an owner-occupied property, obviously, if we can keep the loan-to-value ratio under 80%, we're avoiding that nasty lender's mortgage insurance. That's where that helps.
Thank you. A similar question, actually, I might leave it with you, Carly. If you own your first property, so Dale, I'm assuming this means that you don't have a loan on the property. If you own your first property, should you look to use the equity to purchase a second property, or just start with a fresh new loan?
So that's along a similar path. We would borrow against the first property to complete the purchase of the second property, therefore trying to avoid the lender's mortgage insurance, which we don't want you guys to pay.
Yeah, exactly right. And I suppose, Dale, it comes down to how much cash you want to contribute to this purchase. If you've got the equity to use, there could be a greater tax benefit in using that and borrowing more money versus, you know, a lump sum cash deposit, which you then don't have towards other items, if it's personal or towards the investment property, just as a backup.
Just to jump onto that as well, Dale's got an interesting question. If he owns his property outright and doesn't have any owner-occupied debt, well, then we want to get rid of the debt that he does have, the investment debt that he's taking out. So if we can get that paid down as fast as possible, make that principal and interest, that'd be great.
Yeah. So still use the equity, but a principal and interest loan rather than interest only, perhaps, is what's best. Yeah. I've got a few more questions. I'll just run through these chronologically. How long can you remain on interest-only loans for an investment property? Majula?
We can do 5 years interest only period, or 10 years interest only period. It doesn't really matter.
Yeah, I'll just extend on that a bit. The great part about being able to refinance your loan is that you can extend the interest-only term with another lender. If you reach that cap of 10 years, as Manjula mentioned, you can move your loan to another lender and start fresh. So there's more work involved, but you could theoretically keep an interest-only loan for 30 years.
You just have to keep reapplying and reapplying and reapplying.
Which does mean a new borrowing capacity assessment. Can you still afford an interest-only loan for 5 years, which means only 25 years of principal and interest payments, assuming a 30-year total?
Yeah, gone are the days of taking out a loan and making it interest only for the life of the loan. That used to exist back in the early 2000s, but the government stepped in and put a squash to that about 6 or 7 years ago. They're trying to get the entire industry to steer away from interest-only loans. So while they do allow interest-only loans on investments, they'll usually cap them at 5 years. And as David mentioned, you better reprove you can requalify for that loan every time you want to extend that.
Yeah, it's a bit of a tangent, but a few years ago, some lenders actually had so many interest-only loans on their books that they refused to take anymore. So no one could write an interest-only loan through Great Southern Bank, for instance. They just weren't taking them. So constant reassessment. Anna, could a trust be set up just to purchase a property? David?
Definitely. And that often happens where we've got a company structure or a trust that's set up specifically to hold an investment property. So that happens all the time. And it's quite common for an accountant to purposely open up an individual trust for each purchase of a home. So yes, definitely.
David, I'll keep with you. If this is from an anonymous, if buying under an investment property, under a trust, then is owner-occupier property still considered?
It is. It's just less common, and I don't know what the advantage would be other than maybe protection or even, the transfer issues that we spoke about. But yeah, the accountant would be best to advise if that's wise.
Yeah. Mehul, I've got a question here. Carly, I'll send this your way. I did respond to something similar to Lisa. I'm not too sure if you can see this, Rahul, but what happens if our current loan is locked in with a fixed rate and we would like to purchase an investment property with the equity from our home? Will the equity amount have the same fixed interest rate as the current loan?
So to answer your second question first, no, the equity amount would not have the same fixed interest rate. We would do one of two things. We would give you a separate loan for the investment with your current lender, or actually look at picking up all of your lending and moving it to a new lender if we needed to extend your term out to increase your borrowing capacity.
Yeah, thank you. Just a quick one, and then I've got actually another one for you, Carly. Anonymous, does Mortgage Choice assist with setting up a trust? Short answer is no, but we do have many professionals that we can recommend to assist with setting that trust up. If you need anyone, reach out. Happy to help. Now the question for you, Carly, are buyer's agents tax fees? This is a good one. We didn't talk much about buyer's agents. For those who don't know, a buyer's agent is someone who will source a property for you. So you'll pay them a fee because they find you a property that suits your needs, purchase price, potentially location, number of bedrooms, what you're looking for. They'll find the property for you. Like instead of a real estate agent sells it, they'll find it for you to buy. So are buyer's agents' fees tax deductible, Carly?
Short answer, yes and no. Initially, when you purchase the property, it's just considered part of the total purchase costs that sort of come into play when you buy. Sorry. But you can claim them at the time you sell your property and when your capital gains tax is calculated.
Yeah, it's a good distinction there. And capital gains tax, DT, you touched on that a little bit in the webinar.
Yeah, capital gains tax is the tax that you pay on the profit on the property. So as an example, if Mary Smith bought that property at 600,000 and sold it at 1 million, she would have earned $400,000 less any upfront costs, and then she would have to pay tax on that $400,000. Usually, if you hold a property more than 2 years, I believe you get a 50% reduction in capital gains. So she would only pay tax on 200,000 at her current tax rate. So if her current tax rate is 30%, for example, she'd pay $60,000 in total capital gains tax.
Yeah, and current tax rates is also a really good point to bring up there, because if you hold a property to retirement when you don't have any taxable income, CGT, capital gains tax, is reduced, which is another strategy that the accountant can talk with you about. So it can get quite complicated. This is why we need to speak with the professionals. Ilias, great to hear from you. Who determines the amount of equity on your home? Really good question. Do we need to get an evaluation from an estate agent, or can Mortgage Choice assist with this? Really good question. An agent can certainly confirm the equity in your property, but that will only be used in terms of a sale. So if you're looking to use equity in your property and take out a new loan against that equity, then we need a bank valuation. Yeah. And we can assist with that. Yeah, for free. A couple more anonymous questions. What are your chances of getting a fresh loan for your investment property when your first home is still in construction stage due to delays with the building industry? Yeah, this can be a bit of a tricky one. David, did you want to field that?
Yeah, look, the quick answer is likely not. And it's probably something that even if you could do, I would be strongly recommending that you not do it until your home is completed. If the question is, can you borrow against the existing home under construction to access equity? No, there's no lender that will allow you to do a new loan against a property when it's in the middle of construction. So unfortunately, we couldn't access equity from that home. And I'd be recommending, especially with the delays that we've seen, and I'm building and I've gone through delays of my own, you just want more peace of mind and more certainty when you're making this big purchase. So I would be saying to hold off until you're done building. Yeah,
it's a good point. Are you actually using that property under construction as a security for this new purchase or not? If that just happens to be in the background, then your chances of getting the loan for this investment are okay, but it's obviously subjective. We need to assess your situation. But then the bigger question is, will this jeopardize the purchase of your home when that construction is complete? So becomes a bit more complicated. Another anonymous question, even though I would want to invest in a rental property via my owner occupied property, how would the banks calculate my servicing? This is a really good question. Manjula, do you mind taking that one?
We would, like David mentioned earlier, we would use equity from your owner occupied property and we would calculate servicing. We would use 80% of rental income for servicing, and we would also use your income for servicing as well. But feel free to reach out to us and we'll be happy to help you with this.
Yeah, exactly. Essentially, banks want to look at your expenses and your income. So what are you spending on everyday costs, living, transport? What expenses do you have with a credit card or an existing mortgage? And what income do you have? Rental income, as Manjula said, not all banks will take all of the income that you receive. They'll only take a portion. And what income do you receive from your job or from a business? Does your income outweigh your expenses? That's the question.
Just further to that too, just to clarify, the banks will also take proposed rental income. So the property might not be an existing rental with income, but we get an assessment done as to what it would be rented for, and they use that towards the servicing of the loan.
Yeah, it's a really great point. And coming back to Elias's question before, that appraisal is something that we can take from an agent. It needs to be in line with bank expectations. We've just got another one come through, Steve. Hope all is well. Can the same approach to leveraging the building of an investment property rather than buying an existing property? This is a really good question. It does come with some different benefits. David, did you want to jump on that?
Sorry, let me just read this again. Can the same approach to leveraging equity be used for financing the build of an investment property rather than buying it? Definitely. And we basically treat this the exact same as we did in the case study. We would go to your existing lender or a new lender, and we would refinance your existing loan. We would take out the necessary 20% deposit against your existing home, and then would prepare ourselves with the pre-approval for the purchase. So the lending strategy here would be the exact same process, even though it's a different type of property we're purchasing. What it might change though, Stephen, is the lender that we go through, because not all lenders will do construction loans. So as an example, you might be with ING right now, and ING, because they don't do construction loans, we would need to take you to a lender that would allow us to do construction. So that's just one of the examples of foresight that we need to have when we're making the right decisions.
Yeah. I really want to expand on this a bit further, because we have really spoken about established properties when purchasing an investment, but you can build similar to that property that hasn't quite finished. You can buy off the plan. So you can actually buy a property that's currently in development and not pay for it until it's finished, versus building where you're paying for it in stages. You pay for the land and then you pay every time the builder completes a stage. When you're investing in property, depreciation does change, obviously, depending on when the property was built and what kind of fixtures and fittings are in that property. So building a property or purchasing an off the plan property means that you'll likely have more depreciation for the first few years than you would buying an established property that's already depreciated for 5-10 years. So there's an added benefit in building it. One of the costs of building, not so much off the plan because you don't pay until it's done, but cost of building is that you pay interest on the land, you pay interest on the build until it's finished. You can't rent it out until someone's able to live in there. So you can't obtain rental income whilst you're building, which means that's just an out-of-pocket cost to wear until the property is actually tenantable, leasable. You can put someone in there, occupy. I've got a few more questions that have come through. Are there any differences or pros and cons when investing in commercial property instead of residential? This is a good question. I might pass this back to you as well, David.
Yeah, great question, Lisa and Christian. Hope you're both well. So definitely some lending differences with commercial lending, because usually commercial lenders will only lend up to 70, sometimes even 60% for a commercial property. There are some banks that do 80%, but they're harder to find. So we may need to access more equity in your existing home to allow for the deposit on the purchase. There are also fewer banks that will do commercial lending. And there are higher rates and higher fees and oftentimes shorter loan terms available with commercial lending. So it's just a different beast entirely with its own set of rules. So we need to, as we've said before, step through what you're thinking about and then work out what our options are.
Yeah. Just another question from Ilias. Can you combine equity from multiple properties, owner-occupied or investment, for a new investment property purchase? Absolutely. Yep. So comes back to the available equity in a property and obviously your affordability. If you've got, for argument's sake, you've got 10% accessible equity in one property and 10% accessible equity in another, you can merge those two. What it comes down to is that structure where you do just have the 10% loan against this property, 10% against another, and the 80% against the new purchase. So it just splits it a little bit further down the line. That looks like all of the questions that we've had so far.
Great questions tonight. This is fantastic.
Really good questions, yeah. And we'll be sending out a copy of the webinar tomorrow. So that will have a copy of a recording of all of these questions so that you can run through them again if you did miss anything. So wanted to say thank you. And again, we'll get a recording sent out. We'll also get a couple of spreadsheets and some checklists for purchasing your investment property via Equity in Your Home. We'll get those sent out tomorrow. So thank you everyone for attending. I'd like to thank my co-hosts, David, my panelists, Manjula, Carly, and Ash there for helping with the questions as well. Enjoy your night, everyone. I look forward to speaking soon.
Fantastic. Thanks, guys.
Thanks. Bye.